Hello, and welcome to Value Screening. We are diving into a fascinating investment thesis, Bristol-Myers Squibb, BMY. The stock is currently trading at a staggering 38% discount to our calculated fair value. The question isn't whether BMY is cheap, but whether it's safe and correctly priced. To answer that, we rely on our triple-check value screening methodology. This isn't guesswork. It's a systematic three-stage filter that isolates superior businesses. It moves from broad stage 1, valuation, to surgical stage 2, financial resilience, and ends with a solid stage 3, price target, based on objective competitor data. This process sets the floor for our investment, ensures safety isn't speculation, and makes our valuation actionable. You can see the company circled on the free cash flow yield benchmarking chart. The red line represents the average for the entire index, typically sitting around 5.24%. Most of the market clusters right around or below that line, but for value investors, we are looking for an anomaly. Now, look at our candidate. While the market average is 5.24%, BMY's yield is an astounding 16.51%. This is slightly over 3 times higher than the index average. The free cash flow yield benchmarking instantly confirms BMY is a cash flow outlier and passes our initial check. However, a high yield could still be a trap. We need to apply our ultimate safety check to ensure this cash flow is sustainable. We've confirmed the stock is cheap, but is the cash flow safe? When we plot the residual free cash flow yield, the S&P 500 average has plummeted to just 3.4%. Why? Because most companies use up the bulk of their free cash flow to service debt or pay dividends, leaving little true surplus. But despite subtracting its substantial dividend payments and interest expenses, BMY still maintains a residual free cash flow yield of 8.9%. This result is phenomenal. It proves that the company's cash generation is so powerful that even after meeting all its financial obligations, it still has a surplus yield more than 2.5 times higher than the average S&P 500 company. This 8.9% confirms the unquestionable financial safety we require. We arrive at stage 3, peer comparison. We know the stock is cheap and financially resilient. Now we determine the correct price target. This chart plots the residual FCF yield against its closest major rivals, companies like Merck, AbbVie, Pfizer, and Gilead. Look at the sector average residual yield. It sits at a meager 2.8%. This means on average, biggest competitors have very little surplus cash left. But look at Bristol-Myers Squibb at the top, maintaining its massive yield of 8.9%. This is over 3 times the cash safety of its peer group. This outlier status proves durable cash flow outperformance and justifies valuing it closer to the high multiple competitors. This allows us to confidently translate that superior cash metric into a final price. Our approach is different. We use the superior cash flow resilience to set a rational value, and that leads us to our calculated fair price of $68.64. The market is terrified that BMY will lose significant revenue as key drug patents expire. Our target is not a guarantee, but a powerful reference point. Crucially, our calculated fair price of $68.64 has already factored in the substantial risk the company carries regarding the patent cliff and projected revenue losses. We did not ignore the risk, we quantified the downside and still arrived at this price. The difference between our fair value and the current stock price is the margin of safety, our buffer against uncertainty. What defends our thesis against the patent cliff? The very metric we focused on, residual free cash flow. Because BMY generates such a massive cash surplus, it has unparalleled optionality. It can use that 8.9% yield to aggressively fund a late-stage R&D pipeline, make strategic growth-driving acquisitions, or deploy share buybacks to defend the stock price against bearish sentiment. This is why we are confident a company with the financial resilience we demand has a value closer to our target than the volatile forecast of the street. Our final key takeaways that solidify the BMY thesis. First, financial resilience is confirmed by the high 8.9% residual free cash flow yield, proving the company can comfortably cover all committed expenses despite market fears. Second, risk is quantified because our calculated fair price of $68.64 has already factored in the anticipated patent cliff and revenue declines. And third, the opportunity is the valuation gap. The stock trades at a 38% discount, offering a significant and powerful margin of safety for entry. We have completed the analysis, but our job as analysts is never finished. This final slide is your action plan to actively monitor this investment. Own the risk by actively tracking management's official response and R&D budget for replacing the lost revenue. Validate the target by examining how the top rivals spend their own cash surplus. And monitor the upside by watching for major product launches or clinical trial milestones. These positive events are the key catalysts that will drive the stock price toward our calculated fair price. The methodology and analysis you just watched require a significant amount of effort, time, and careful data modeling. My commitment is to bring you the highest quality, most reliable financial insight possible. If you found this video helpful and valuable, please consider supporting this work. Your likes tell us this research is essential, and when you subscribe, you help the channel grow and ensure you don't miss the next deep dive. Thank you for your commitment to financial education, and I look forward to seeing you in the next video.